So what I want to do tonight is go through the class notes on the economics of P&C insurance, and then we'll wait till Tuesday to talk about paper two, and paper one. We'll spend a lot of time on paper one because I really want you to be ready for paper one with the detailed discussion I want. So I've got class notes out there on Canvas, and we'll walk through the class notes. I don't use PowerPoint mainly because I don't want you to have two sets of documents. So I like to use the class notes just so you can say exactly, you only have one group, so you can take your notes. If you miss a class, you can make up 3 classes by watching Zoom. Just make sure you take good notes so you have something to turn in that prove that you watched the video. So if you want to find class notes in Canvas, it's right up here at the top. I give a little bit of overview on the papers. We'll get into this more when we get into the paper. And we'll talk more as we get further along about topics for paper 2. I'll give you some websites that you could use. Paper topics in the past, I have had students really interested in cybersecurity, and that is a huge issue for the P&C industry. How do you handle these ransomware and these attacks on computers? Driverless cars is still an issue. It's still a discussion. It's a pretty interesting one. It's still probably years away. I do believe there are some driverless taxis in a few cities. So it's kind of interesting on that side. I've got some articles there linked. So it's interesting. The insurance industry, a lot of companies say it's no big deal. There are a few insurance companies that have actually added footnotes to their financials about the risk of driverless cars. So they're starting to think about it. I'm hoping it takes off. I'm hoping when I'm 75 and they don't let me drive anymore, I just don't have a car, and I can just do everything, not Uber, but I just put it on my phone and a car drives up and takes me somewhere. It's kind of nice to, get dropped off at the doorstep of every place. We'll see if we get that advanced or not, but it's going to be there. Terrorism has been an issue in the past. We're talking about that now with paper 1, but how do insurance companies handle that? And there is a federal program that they started to handle this, mainly because after 9/11, firms couldn't build big buildings anymore because no one would insure them. And so the federal government had to step in and provide a backstop. Regulation of auto insurance can be an interesting topic. Global warming or climate change has been a big issue. We've definitely seen that in California and other places, and there's a lot on that. I don't think this one really works. Affordable Care Act, someone tried it once. I don't think it works all that much. This one's a little too old. Actually, I had one student write a paper on this, and it was quite exceptional. The gig economy to me is a really, really interesting. And I just saw a former student, Bond. He worked for Buckle. I don't think Buckle exists anymore. We can see. I think they went out of business, not because of him, but let's see if they still have a website. So Buckle is an interesting company because their whole goal as a company is to provide insurance to the gig economy. So someone has an Airbnb, they want to have insurance for that, or someone's doing Uber or Lyft. You can't just do Uber and assume if you have an accident, you're covered by your auto insurance because you're now in a business, and a business is a different risk. So how do you handle that? So Buckle was set up to do that. It looks like they're still in business, but they've struggled somewhat. The CEO of Buckle used to be the CFO of USA, and then she moved over to Buckle. So it was interesting talking to her again. Now she's in a whole new function. But the gig economy is pretty interesting. I had one student or a few students last semester talk about catastrophe bonds. I think 3 of them did that. They had to write their individual paper, but then they presented as a group on catastrophe bonds. Very, very fascinating topic, and there's a lot you can do there. There are places you can go to get ideas. If you're an actuary, I strongly recommend you find one of these really, really actuarial ones. We'll get into some of these. There's some really great topics up here. So RMS is a cat modeling firm. They're owned by Moody's now. Find insurance solutions expertise. So yeah, it's not letting me move down resources. But when you go on these websites, you can usually find some really, really good topics. This one's not working really well, so let me try another one. I didn't write. So RMS, they're famous for earthquakes. They do modeling for earthquakes. They also do wind as well, but they're starting with earthquakes. So they're really a California. Can you guess where air started? What do you think they started off modeling? Can y'all tell now? Hurricanes. They start off, they do earthquakes as well. They're still on, well, they're owned by Verisk. Our focus, P&C insurance, property casualty insurance, underwriting rating claims, extreme risk events. That could be a pretty interesting topic. So these websites tend to have some really, really great articles and research, which is exactly what you need for paper two. You need one or two really, really good articles that you can do a summary of. So these websites do a great job of really bringing together. And because they are actuarial firms, they tend to be really, really sophisticated articles. This isn't watered down for the retail investor. This is for sophisticated people. So that's a great website. And then one of my favorite firms, if I were an actuary, I'd be shooting for this. That's my dream job. Swiss Re. They probably have jobs in the United States. And they have a database, articles on all kinds of topics related to property casualty insurance that would make really good topics. So there's places you can start researching to look for. There's other sites we'll talk about as we go, but Swiss Re is one of my favorite. They came to USA one meeting, and I just sat there going, man, I wish I worked for this firm. They were really smart people. They're so passionate about their job. They're like laughing and just really getting into it. It's like, wow, this would be a great firm to work for. They do a lot of stuff outside of P&C, so you'll see a lot of interesting articles. Yeah, we're going to talk about D&O insurance. They've got a blog talking about financial market risk, transforming data-driven dialogue and action toward new global equilibrium. Who knows what that means? No telling, but they're smart people. So we'll find some other topics as we go. Some of them are a little bit dated, so you're probably not going to find good data on. I read The Economist every week, and there have been some really interesting articles on P&C. I just got an article, I think from Yahoo Finance, on how condos are having trouble finding insurance right now. California is a big part of it, but condos, an 80-unit condo, I think I remember the numbers. So there's 80 people living here, and the insurance was like $230,000. So $3,000 a year. It may have been 2.3 million. I can't remember. 2.3 million would make it pretty high. I think it is actually, it was a ridiculous sum. When people saw their condo fee, that was going to be $1,000 a month, or like, and that's just for the insurance coverage. Doesn't include everything else I got to pay for with this condo. It was pretty scary. So there are some special issues coming up. One topic you could certainly do, which is near and dear to my heart, is title insurance reform. We'll talk about title insurance. I hate title insurance. I think it needs to be disrupted. So that's one. It's hard to find a lot of data on that. There are articles out there. I'll show you one. It's really dated just because I cannot find more recent ones. But there's stuff out there that you can do. But start thinking about paper two. The reason I want you to think about it is if you see an article, you know, if I see an article in The Economist, I'll show it to you. But if you see an article or you see a TV, it doesn't necessarily have to be an article. It can be a TV documentary, something you see discussing a property and casualty issue. You could certainly do that. But there's a lot of really, really good topics out there. So start thinking about that. But that's paper two, so you got some time. We're really going to focus Wednesday on paper one. All right, so let's talk about the economics of property and casualty insurance. Some of this does apply to the life side, but the P&C side is more about frequency and severity. The life insurance side is more investment related. So the key here is frequency. That can either be the probability of a loss or the number of claims, the number of losses, depending on how the problem is stated, times the severity. The severity is the average claim. So on paper one, you definitely want the words frequency and severity in your discussion. Those actual terms. I don't know if he uses it in the article himself, but he definitely uses terms that refer to frequency and severity, even though you might not use those exact terms. That gives you the expected loss. Frequency times severity is your expected loss. We also call that the pure premium. You'll see that when we talk about credit scores. That's the pure premium. So you've got a 22-year-old male in a ridiculous car. I don't think there is an 8-cylinder car, but a ridiculous car has a 2% chance of totaling the car. The car is worth $50,000. So their expected loss is 2% times 50,000 or 1,000. That's the absolute minimum the insurance company is going to charge. And they're going to add on top of that profit and expenses. How much will they add on top of that? Do y'all remember the loss ratio, expense ratio, loss ratio plus expense ratio? Y'all remember these? For auto insurance, this was about 70%. This was about 25%. That's about 95%. Anybody remember what we called this? The loss ratio plus the expense ratio, another term you want in paper one? Very good, combined ratio. So if your combined ratio is below 100 or below 1, you're making money on the underwriting. If it's above 1, you're losing money on underwriting. But what does the combined ratio ignore? It excludes investment. That's actually another possible paper one topic. It's called the underwriting cycle. Let's see if we can find any articles because it's kind of been disrupted. P&C underwriting cycle. Here's one. Understanding what drives the underwriting cycle, underwriting cycles and shocks. So yeah, it is a term. So what we usually think of underwriting cycle is insurance companies have high combined ratios where they're losing money and low combined ratios are making money. And the question of that is the relationship between combined ratios and interest rates. Because remember, the combined ratio excludes investment earnings. So if interest rates are really high, you can have a higher combined ratio because you have more investment earnings to offset the losses. If interest rates are really low, you should have lower combined ratios because you need to make more money on underwriting because you're not making as much on investments. So if you actually did a correlation between combined ratios and interest rates, you'll see that combined ratios are high where interest rates are high. They lose money on underwriting, but they make more money on investing. And combined ratios are low when interest rates are low because they make more money on underwriting because they're not making as much money on the investment side. So that is a topic that's related somewhat here. So the insurance, the pure premium is only this 70%. It's the part of the premium that just covers the losses. Questions on that? So try to work the word combined ratio into your, Warren Buffett talks about if you have a premium of $100 and your combined ratio is only 95, you essentially got paid for borrowing someone's money. You borrowed $100 and you only had to pay $95 back. It's as if you had a negative interest rate. That's why combined ratio is so important. Now remember what he said. He said most of the time the combined ratio is above 1, but we saw in auto insurance that's not the case. We saw with Progressive, they averaged about 92%. So their combined ratio was well below 1. It's a very nice business. Auto insurance is a really, really nice business. What do you think homeowners does? Well, it goes from like 85, 80, 75, 80, 130 because of a major hurricane, and it goes back to 85. Homeowners averages below 1, but it has these horrible, horrible years of major earthquakes and hurricanes where they lose a lot. So it can be much more volatile. So frequency and severity, very, very important. Working into your first paper. Okay, so insurance is priced. So it's a bad deal for you as the policyholder. You cannot do a net present value of insurance because it's always going to be negative. You're expected to pay much more in premiums than you're going to get back. Because what do you get back up here? You only get the loss. You get the claims back. You only get 70% back. 25% goes to the insurance company to cover their expenses, and the other 5% is their profit. So when you spend $100 on auto insurance over your lifetime, you're only expecting to get 70% of that back. Can you have a positive net present value? Well, if you have a really serious accident, and yeah, if you're lucky, and you pay $100 in premiums, and you suddenly have a big accident, and you get $20,000, yeah, you can. You can come out ahead. You don't want to, right? Because you have to have a serious accident. But insurance is priced for you to lose, and it's the only way it can work. There's no way the insurance company can charge you $100 and pay you $100, and they make money because they have expenses, they have profits. So it has to be that way. So you know it's a losing proposition. It's an expected loss. So that means you're better off not buying the insurance. So why in the world do you buy it? So we'll get into that. Why is this expense ratio so high? Progressives was like 18, 19%. USA was like 30% before they did their restructure. It is probably back up to there now. But it's expensive. Why? P&C companies have some really expensive professionals. They have actuaries. Actuaries are expensive. Y'all like that. If you're an actuary major, you like it that they're expensive. They have underwriters. We'll talk about this. For an actuary that doesn't pass an exam but needs to get into the industry, underwriting is the way to go. And then you can move back to actuary when you get the exams done. So underwriting actuaries are real similar. Walmart doesn't have underwriters and actuaries. Apple doesn't have underwriter and actuaries, so very unique to industry. Investment professionals, because of that float, all that money you're getting today, and you got to pay it out in the future, you got to get it invested, so you have to hire investment professionals to do that. And there's other experts out there. At USA, they had a whole department of PhDs in math, a bunch of math experts. I used to go over to the department every day just to talk to them. I learned so much from those people. They were really, really smart, and they didn't seem to mind me coming around. So I got as much free training as I could get from them. So should you buy insurance? We're going to ask this question twice. This is a question on the first exam. So once you get paper 1 done, I would start working on this question. Y'all notice in my class, I don't give you a million things you have to do. I give you a few that I really want you to sink into, and this is one of those. So I'm going to ask 2 questions. When should individuals buy insurance? So I'm assuming you should buy insurance, but when should you? But you notice on corporations, I don't ask when should corporations buy insurance. I'm going to ask why do they? Because we're going to discover what you learn in finance implies that corporations should not buy insurance, that it's a waste of money. So we're going to theoretically say why insurance should not be purchased by corporations. But then they do buy insurance. So why do they buy insurance if the theory says they shouldn't? Okay. So it's different between individuals and corporations. And I'm going to answer it further down. I'm going to answer these questions. This one we're going to answer pretty straightforward and simple. This one's going to take some time, and it's an essay question on the first exam. And I highly recommend you, when we talk about it in class, you're taking notes so you can get it ready to submit for the exam. What some students do is they sit there with nothing to write on, no notes. They just listen. And in a few weeks, several weeks later, it's time for the exam. They figure out everything we talked about. And now they got to start from scratch, go back and watch the lecture. You're much better off writing it in class. All right, so we're going to ask that question. What does the capital asset pricing model say about corporations buying insurance? Why does it say they shouldn't buy insurance? And then given that they do buy insurance, why do they do that? All right, we'll get into that in detail. And then the third question we'll ask is, when should insurance companies sell insurance? And that has a very huge overlap with what Warren Buffett's talking about for paper one. He's talking about how Warren Buffett, how Berkshire Hathaway can sell insurance, right? So you got individuals, you got corporations, you have insurance companies talking about the economics of this, all right? So let's start with the first question. When should you buy insurance? It all comes down to frequency, severity, and rate online. Let me load the rate online file. We can talk about it. I think this is a really, really important concept when you're buying insurance, to think in these terms. All right. So you as an individual, your decision about insurance should be closely tied to the concepts of frequency and severity. So there's four options: low frequency, low severity, low frequency, high severity, high frequency, low severity, high frequency, high severity. There's four combinations. So let's start with the first one. It doesn't happen very often. And when it happens, it doesn't cost you very much. What do we say back up here? Insurance is going to lose you money. Anytime you buy insurance, you're only expected on average to lose money. Should you buy insurance for something that doesn't happen often, and when it happens, it doesn't hurt you very much? No, because you're just losing money. So insurance is priced to lose you money. Why would you do that? Now, there are examples of that. Warranties on low-cost items don't make sense. I always tell the story, some of y'all may have heard it in previous classes, but I just find it hilarious. I haven't owned a TV in years, but my last TV was this itty bitty black and white TV. That's all I had. And it broke, so I went to Conn's and bought a $16 black and white TV to replace it. And I go up to the front, give them the TV, and they ask me, do you want the warranty on that? For the warranty on it. He says, yeah, we have a warranty. You can buy a warranty. I said, why would I buy a warranty? He says, well, it's $9. The TV's $16. Why would I pay $9 for a warranty on a $16 TV? I said, you got to be crazy. And he laughs. Said, yeah, but do you want it? I was like, no, I don't want it. I told him if I drop it walking to my car, I'll come back in and buy another one and go home. It's not that big of a deal. If I buy the warranty and then the TV breaks a year from now, I'm not going to find the warranty anyway. It's going to be somewhere in some drawer that I'll never find it. So I won't even get the claim. If I do find the warranty, there's probably some footnote that tells me it doesn't cover that anyway because it broke on a Tuesday instead of on a Thursday or whatever. Yeah, it's a waste of money. A lot of people do this. I bet some of you in this room, if you want to defend yourself, I bought the Apple phone insurance. If it breaks or goes under, why does Apple like selling that? Do you think they're doing that as a lot losing product they're not making money on? Or do you think they're making money on that? Guarantee you they're making money on it, which means what? On average, you're losing. So you're better off not buying it. If you can afford to buy a new Apple phone, then don't buy the warranty. On auto insurance, this is debatable. Towing and labor is a low frequency event. It's also fairly low severity. $50, $100. You say, well, it only cost me, $15 a year or whatever. But if you get towed once every 10 years, you're going to pay $150 and it's going to cover you $100. You're worse off. I would say just don't mess with it. But a lot of people buy it. Why? Because it's so cheap. Why is it so cheap? Because it's low frequency, low severity. The insurance company loves it because they make a lot of money off of it. My opinion, don't buy insurance on stuff that you can pay out of pocket. You may not like it, but it's once every decade. You got to spend $100 for towing. Why pay $10 a year for the insurance? You might as well save your money. I think the best thing to do here is just retain and do loss control. Do things like Make it less like, I shouldn't be tossing the TV set up in the air when I'm walking to my car. There's things I can do to protect it. But risk retention is the best approach. So always remember, every insurance contract is an expected loss transaction. And if you remember that, you don't want to waste money on this, mainly because the place you do want to buy insurance, you can get a lot of insurance for a very low price. So the money you're spending on this, you can actually pick up a lot of really valuable insurance by spending this money somewhere else. We'll talk about part B and C of auto insurance. I think it's a waste of money, but I've never convinced the class yet. I'm worried a bunch of students can go out and cancel B and C and then right after that have a claim and be mad at me. So I'm not making any recommendations, but for me, it makes no sense. All right, the second one, it happens all the time. And when it happens, it doesn't cost you much money. Well, there even more so you don't want to do it. Because if it happens all the time, the insurance company's got to hire a bunch of people to manage this, which means it's going to be very expensive insurance. And it's low severity, so you could have handled it yourself. No, this insurance is going to lose you money. But do people do it anyway? Yes, they do. Dental cleanings is probably the best example. Dental insurance is one of the worst insurances out there. What people discover is, oh, I had dental insurance and I have this $20,000 root canal. And then discover that their dental insurance has a really, really low maximum. And so they end up spending $18,000 anyway. I thought I was covered. What does dental insurance cover? So let's think about this for cleanings. Let's say cleaning costs $150 and the insurance is $200 a year. Does it make sense to spend $200 a year to cover a $150 dental cleaning? What would be smarter, do you think? Keep the $200, give them a credit card. That's what I do to go to the dentist office. Here's my credit card. They don't have to fill out any paperwork, send it to the insurance company. They just take my money and I'm out of there. Why do people do this? Well, this might be what they have. You pay $100, your employer pays $100. So it feels like you're paying $100 to cover a $150 expense. But what are you really doing? Well, you're losing $100 from your employer and you're spending $100. So you're still $200 off. You just don't notice because your employer's paying that other difference. So I don't like dental insurance. I think dental insurance could make sense if it only covered those massive, major issues like a root canal or some major surgery. Now, I go to Costa Rica. We have a dental operation there. Y'all want to guess what their dental cleanings cost? Anybody want to guess? You have a child in Costa Rica, go to our dental office. Anybody want to guess what they charge for dental cleaning? Any guesses? 10? No, that'd be excessive. They charge $1 for dental cleaning. For adults, it's $2, so they really rip off the adults. What if you don't have $2? We'll take a chicken. So she loves it. She gets a chicken. We have a wonderful dentist down there. She'll take a chicken. I think, Victor, you saw her, right? Did we meet with the dentist? She might have been gone, but Alexei did that. So Victor's been down there to see. So it's a great operation. And boy, she does everything. She does broken teeth. She does false teeth. It's just amazing. So that's very, very low severity there. She won't do my teeth. She charges U.S. residents a lot more. So the best thing to do there is just self-insure, just out of pocket. Don't waste your money on the insurance. It's going to be more expensive because of high frequency. That high frequency does not work well with insurance companies because they're going to have to hire all these people and take care of that. What if it's high frequency, it happens all the time, and when it happens, it costs you a fortune? Well, if you can find mispriced insurance, then yeah, it would make sense. How often do you find mispriced insurance? Well, my experience with actuaries is that they're really smart people, and so they tend not to misprice insurance. So they're really good at this. What would this be? A very, very sick person trying to buy life or health insurance. Do you think they're going to be able to get away with that? Can they lie on the application? They're in hospice. They got 2 days to live, and they had no medical issues. What happens when they pass away? The insurance company is going to know that they were in a hospital. They're going to figure that out. So insurance companies are very, very good at figuring that out. So you're probably not going to get away with it. If you lie about it on the application, all they have to do is return your premiums. They don't have to pay the claim, so you don't come out ahead. Building a house in a floodplain, building a house on the coast of Florida, on the coast of Texas. You build a $5 million house. I mean, let's even think about that. People do this. I don't know why they do. Let's see you build a house. Let's say it's 5 million. And you think a total loss is, let's say, a 1 in 40 year. So once every 40 years, you're going to lose everything. So 5 million divided by 40. The insurance company, they're expecting on average to spend $125,000 on houses on the coast. Now it might be 0, 0, 0, 0, 0, and then billions because a hurricane hits all at one time. That's the pure premium. Any of y'all going to pay $125,000 a year for homeowners insurance? Doesn't make a lot of sense, does it? But that's what they're going to have to charge. So if you're living on the coast of Galveston or Corpus Christi, 1 in 40 might be a little stretch, but we had Harvey not too long ago. Any of y'all from Houston? Harvey wiped out quite a bit. Maria, especially Puerto Rico, wiped out quite a bit. If I lived on the coast of Texas, I would expect once every 40, every 50 years to see a major, major hurricane. May not total the house, but it's probably going to damage quite severely. I don't know why people don't just live in San Antonio, save the $5 million, and then just stay in a nice 5-star hotel when they visit. It seems to me it'll be a lot smarter. But people like to live on the coast. But anyway, that's the pure premium. So think of it from the insurance company's standpoint. You say, wow, I really need insurance because I'm on the coast. I got all this hurricane exposure. What's the insurance company thinking? Yeah, he lives on the coast. He's got all this hurricane exposure. They're going to essentially take an assessment of what's the probability of a total loss over a certain number of years, and they're going to charge you that. You're going to end up paying for that house twice. It's going to be expensive. We'll talk about that when we talk about homeowners in Texas and why the coast is so expensive. A 16-year-old driver, but if any of y'all, no 16-year-olds or have no parents that have 16-year-olds, boy, that insurance premium is massive. When does it drop? When do guys, now we're talking about male drivers, right? Not female drivers. When do male drivers become not such idiots on the road? What age? I think I heard it. Say it again. 25. Those that my life, I don't really remember this in life insurance. If you look at the mortality table, mortality actually rises year after year after year. So as you age, your chance of dying, except for at 25. At 25, it's the 1 year it drops. That's how material it is. Male drivers are so horrible, you actually see it in the mortality table. Their mortality is high, their chance of dying is higher at age 20 than it is at 25 because they're such terrible drivers. Do women drive better than men, age 20, 25? Absolutely. So yeah, sorry guys, but that's just the truth. Now, are there some male drivers that drive better than female drivers that are 20? There are. What do? They pay more for insurance. There's no way around it. You can do all the convincing, I'm really good, I'm really safe. How can you get around that? Well, insurance companies use credit scores. So really good 20-year-old male drivers also tend to have really good credit scores. And that can be, now what if you're a really good 20-year-old driver with a bad credit score? You're sunk. They will not believe that you are a good driver. It doesn't matter what you say. So it seems unfair. That's what we call a false positive. You've heard that term before, right? You're a good driver, but you're treated as if you're a bad driver. There's almost no way to get around that. There's no way you can prove it. So we got credit scores. The other thing on my phone, I have USAA tracks all of my driving. My hard stops. That tends to be the main thing. They check if I use my phone while I'm driving. I never use my phone when I'm driving. I always turn it off. So I always get good scores on that. My challenge with that is it can't tell if I'm driving or riding my bike. So I get these bad scores because I'm on my phone while I'm riding my bike and I think I'm driving really slowly, but I have to go in and change all of those. That is one way. So we'll talk. That's another one I'm going to add to our list of possible. Have you ever heard this term before? Telematics? So that's a good topic. That would be a really interesting topic for people too. So if you look at Root Insurance Company, I don't know if you've ever heard of them. Has anyone heard of Root before? Any of y'all use Root? You might check it out. So Root, it's an AI insurance company. It's really pretty cool. When you sign up for Root, your insurance is going to be pretty expensive. But then they put a monitoring device on your car. If you can prove that you're a really good driver, they'll cut your rates dramatically. And they use AI to monitor it and assess your driving. So you start off more expensive, but if you're one of those 20-year-old male drivers that really is better than average, you don't just think you are in your dreams, if you actually are a better driver, Root is the kind of company you go to because they say, okay, we'll start off charging you like we think you are, a bad male driver. But if after 6 months you prove that you don't use your phone while you're driving, you're not speeding, you're not doing abrupt, jackrabbit starts and abrupt stops, after 6 months, we'll give you a great discount and you'll come back in. So this Root is the company for those really good drivers that are being treated like bad drivers. It's an interesting firm. I love the AI aspect of it. So you could probably use their website to go in and do more research on them. So if you can't get cheap insurance, which you probably can't, you're just out of luck. So if you're buying a house on the coast, your best move is just to sell the house, move somewhere else, visit the coast, stay in a condo, and in retention. The key for a very sick person is that they bought the insurance before they became sick. That's really, really critical. That's the nature of insurance. If you could buy insurance only when you needed it, it would never work. So let's say I can buy auto insurance. I'll just buy it when I have the accident. That product doesn't work. So they're never going to sell that to you. So the key to getting around this is to buy the insurance before you need it. Then it's cheap. And then when you have the accident, you can get it. But otherwise, you're probably going to have to retain it. So the real key for insurance is this last one. This is when you buy insurance. Low frequency and high severity. Now you have to define severity. So for me, severity is probably much higher than a college student because I got my wealth saved up over a lifetime. So each person has to decide what is high severity, high frequency. It can kind of go both directions. I'm really worried about liability risk. So I have an umbrella policy because I'm worried about, I crash into a bus with 40 kids on it and it's all my fault. That's going to be a massive liability suit. If my net worth was $27, I might not care about that. So, someone might say, well, that's a big severity, but sue me, I have no money. So you can kind of define it depending on your situation. This is the perfect place for insurance. So low frequency keeps the costs low because the insurance company is not dealing with claims every single day. And then the high severity is important because you have something when it happens, it's going to wipe you out. You may know you're paying more for the insurance than you're going to get back, but you can't handle a $25,000 expense. You'd rather pay more than the cost of what you expect back rather than experience that. And I like to think of it rate online. So I love this concept of rate online. The actuaries taught it to me. Makes a lot of sense. These are actual numbers from my auto insurance. I did this on USA.com. You probably can do this if you're using Allstate or whoever. What you do is you go in and you pick the deductible. So deductible, this is Part D, which is collision and comprehensive. So this is damage to your car. We'll talk more about auto insurance. So Part D is the physical damage to your car, right? Y'all understand the deductible, I would assume. So if you have an accident and your deductible is $100, you have to pay the first 100. The insurance pays everything else. Your deductible is $1,000 and you have a $900 damage to your car, you're going to have to pay for the entire thing. The insurance company pays nothing. You have 100, you have $900 in damages. You pay the first 100, they pay the next 800. What happens to your premium as you increase your deductible? Does it rise or fall? Let me know that you're breathing and you're out there. Does it rise or fall? You increase your deductible, it's going to fall. All right, so the rate online is looking at your additional coverage versus the additional premium. All right. So if you go from $1,000 deductible to $500 deductible, you're getting $500 more coverage. Everybody agree with that? And it costs you an extra $46. So your rate online is 9.31%. Your additional premium divided by your additional coverage. If you go from $500 to $100, you pick up $400 in coverage, but it costs you $140. That's a 35% deductible. I use $1,000, but 500 is not a bad decision because it doesn't cost me that much more and I get $500 in coverage. What about the 100? 100 is a terrible deductible. You're going to pay this every 3 years. You're going to pay that entire deductible just in your premium. If you're not having an accident every 3 years, just doesn't make sense. You're spending a lot of money. Now, if you have an accident every 2 to 3 years, you're probably going to lose your coverage anyway because they're not going to want to cover you. So do this with your insurance company and just find that sweet spot. I wish I could even go higher than $1,000. My car hit 11 years old, so I just took Part D off entirely. I figure if I total it, I'll just leave it on the side of the road, go buy a new car and go home. Because to me, it didn't matter. It's an 11-year-old car. Just cancel it entirely. But that's comp and collision, so damage to your car. These were my, I think, annual premiums. I don't think it was the 6-month premium. So try this with your insurance company. With USAA, you just go into the billing side, and they have places where you can check. Make sure you don't hit, confirm that you want to do it if you're not sure what you want to do. Same thing with Part C and D. You can price those and see how much they are. When we talk about that later, you're going to see you're probably spending 150, 200 bucks on that. I don't care for those because I'm worried about Part A. Anybody know what Part A is? What are we left with? I'm sorry, I said C and D. I meant B and C. Excuse me. Sorry, that was confusing. Parts B and C. Part A is liability. The 200 bucks I'm saving on Parts B and C, I put into Part A, and I picked up hundreds of thousands of dollars of coverage. I mean, it's massive. Why? Because Part A is a very low frequency, high severity. You can get a lot of Part A coverage for very, very low premium. That's what I'm worried about because I got my net worth sitting there. I don't want to be sued. So I'm covered for Part A. I have my deductible as high as I can get it, $1,000. I don't do Parts B and C. And all that premium savings I put into liability because that's what I'm worried about. You might be the exact opposite. You might be on Part A, sue me. What are you going to get? You can get my cat and I got a bike and that's it. You got it. But other than that, I don't have anything to give you. And if you don't have any money, they're probably not going to sue you. They're not going to sue people who don't have a lot of money. So you may not be worried about that. You may be more worried about Part D and worried if you had an accident, replace your car. But that rate online works for each of these. Part B and C, I think, is important because we're talking about additional coverage. And the reason I don't like Parts B and C is most of Parts B and C, it's mostly health insurance. I already have health insurance. I don't need another health insurance policy. What do health insurance companies do if you have Parts B and C? Your auto insurance pays for it. What does health insurance do if you don't have Parts B and C? Your health insurance pays for it. I already have health insurance. I don't want another health insurance policy I'll pay $200 for. I'll just have this policy pay for it. So in my mind, parts B and C do not give me much additional coverage, not anything I really care about. So I'm just going to save the premium. Some people say, well, if I don't have health insurance, I need B and C. We'll talk about that. I think that's a bad argument as well. But that's that idea of don't just look at the premium and say, oh, it's only $476. Don't say, yeah, that's not that much more than $336. Think about what you're getting. You're only getting $400 more in coverage and you're paying an extra $140. So think on the margin, really, really important way to assess. Any questions on the rate online? Now, when we talk about catastrophe risk, you could multiply these numbers by 1,000,000. So USA might be buying an extra $500 million of coverage. But it's the same concept. How much more am I paying for the additional coverage? And you look at it as a percentage. So running lines are really, really good way to do it. I have that Excel out there. You can load your own numbers. All right. So you want to find things by your definition or lowest frequency. I don't know how you define that. And higher severity will depend on what you can handle. You can think of that as a catastrophe. And you want to scrutinize. And this is where a lot of people make a mistake, is they really don't know where they're spending their insurance money. Like most of y'all probably don't know if you have B and C. It's hard to assess if it's the right decision if you don't even know you're buying it. So you really want to sit down and say, well, what insurance do you have? You have auto, right? Most of y'all, hopefully, don't tell me you don't have auto. Well, what is auto? It's liability. It's uninsured motorist. It's med. And it's collision. So it's A, B, C, and D. So don't think of it, you have auto insurance. Think of it that you have 4 insurance policies. You're paying for each one of these. So think about each one. Which one are you most worried about? How much are you paying for each one? So if you're paying 150 here and 50 here, there's $200 that you're spending. Is that the best use of your money? If you're paying $500 here because your deductible is $100, so you really have to delve in. What else do you have? You might have homeowners. What does homeowners have? Liability and property. You have a few others we'll talk about. It's actually backwards, B and A. How much are you paying for the liability side, the property side? Which is more expensive, homeowners liability or auto liability, do you think? Where are you riskier? Are you like hurting people all over the place because of what you're doing in your house? Are you more likely to hurt someone on your car or in your house? What's more likely? What's the biggest claim on homeowners liability? I would guess it's dogs. Right? Dog bites. There's where I ride my bike. I come down this hill 30 miles an hour, and there's this stupid little dog that runs out of nowhere right in front of me. There's one time, I mean, I was going to die and he was going to die. I was more sad about the first one, but the owners know it. They see their dog doing that all the time. Do you think I would have an insurance claim against that family that knows their dog is out attacking people and they do nothing about it? Yeah, dogs are a huge one, but not as dangerous as what you do in the cars. So you look at each one of these and make sure you know what you're paying for each one of these. You may not have homeowners, you might have renters. What does renters have? Liability and property, but the property is much smaller because you don't have to pay for the structure. You're only paying for your own property. So it's going to be much lower. Don't say, well, it's real cheap, I should get it. It's cheap, but it's not cheap relative to the additional coverage. So you always think about what am I paying for versus what am I getting? Okay. I don't know what other insurance you have on the property and casualty side, probably not much more than that. But on each one of these, you want to sit down and know specifically what you're paying for that part of the coverage, not auto insurance, but the 4 pieces of auto, not homeowners or renter, but the 2 pieces of homeowners and renters. Know specifically what you're paying for them. And then ask questions about the limits and the deductibles. What if I change my limits? So for liability, I changed my limits from a few $100,000 to several $1,000,000. The premium hardly went up. It's pretty amazing how cheap liability insurance is. So yeah, I'm gonna do my rating line is really, really small. Why? Because they don't think I'm gonna do anything that horrible. So obviously they don't know me that well, I guess, but that's a lot of insurance for very little premium. I'll look at the collision. Wow, if I raise my deductible from 100 to 1,000, boy, I'm saving a lot of money. I'll put that under liability. That's the type of analysis you want to do, but never do it without thinking about the additional coverage. What are you actually getting? Remember, towing and labor is really cheap, but it doesn't cover much. All right, so you got to be real careful what you do. And that's the other thing on these is towing and labor is part of that collision part. So you got to think about what are those additional add-ons. So USA does it really, really well. They got buttons. And the way I did it is I would just do the policy and click one button off, see how the premium changed, click it back on. You can real easily get this this analysis done. And it's a good way to manage your money. I think 95% of people, maybe even more, just do what everybody else. If you call the insurance company, what are they going to tell you to do? Which of these would they tell you to buy? All four of them. Why would they do that? Because that's how they make money. Right? So if you call them and say, hey, can I get out of B and C, they're going to make you feel like an idiot. How could you be that stupid? It's so important. I'm going to show you some articles. People argue you have to have B and C, and the arguments are so ridiculous. So you can't necessarily let the insurance company make the decision for you. You've got to really stop and think. What I do with insurance companies, I say, walk me through a scenario where I'm worse off if I don't have this insurance. They say, well, if that happens, I say, yeah, but I already have that insurance. Oh, but if this happens, yeah, I don't care about that. I don't have that issue. Just, everything they go through, I say, I don't care. They may go to that list and say, wow, that I care about that one. That's important to me. I mean, one might be you're injured and you're got to hire someone to come in and clean your house. Like, I don't care about that. I can afford to hire someone to clean my house, and I don't need the insurance paying for that. That to me is a low severity. Plus, I don't care how messy my house is when no one's visiting me anyway. You think through each one of those. For some people, that's a huge deal. It's like some people you might say, wow, I've got to have daycare for my kids because I can't take care of my kids now. I've been so injured. Yeah, that might be material for some people. For other people, it's not material. So when I talk to insurance companies, I say, okay, you say I need this. Give me scenarios where I need this. I have health insurance already. Give me a scenario where I'm going to be glad I have part B and C. And think through that scenario. If it's important to you and it's worth the premium, then buy it. If it's not, don't. The one thing people tell me more than anything else is pain and suffering. You buy B especially, it covers your pain and suffering. My opinion on pain and suffering is I don't care. If I'm in pain, giving me $100,000 doesn't make me any happier. I've had students say, I wouldn't mind being in serious pain and suffering if you give me $1 million, it'd be worth it. I'm like, I don't know, people like that. I mean, I hate pain. I don't enjoy it. I can't, nothing in life is enjoyable if I'm in pain. Giving me $100,000 doesn't help. So I'm not going to say, well, I'm sure glad I bought that uninsured motor. Now I have $100,000. It's like, no, I'm in pain. I want the pain to go away. So that's the one that students say, I really like that. I want someone to pay for my pain and suffering if I get in an accident. If I don't buy B and C, I don't have that. Now I can still get that covered because I can sue the person, but will I get anything from them? If they don't have any insurance, probably not. So I can still sue them. The other thing people talk about is passengers. But we're kind of getting ahead of the game, but I want you to be thinking about this additional coverage. You have passengers in your car that don't have health insurance and you have an accident. They can get covered, especially on the medical, they can get covered. And if I don't have Part C, they don't have health insurance, I'm not covered. Now, what can they do? They can sue me if I'm at fault. But I love it because, like, if my church says, hey, Ron, can you drive these teenagers to whatever thing? It's like, sorry, I don't have Part C. I can't do that. So it gets me out of a lot of that. If you want to ride for me, just realize you better have health insurance because if I have a wreck, you're going to cover it in your own health costs. My problem with that argument that you need this medical for your passengers is why don't they have health insurance? They really think the only time they need healthcare is when they're riding in someone's car. Otherwise, healthcare is not important. That seems kind of crazy to me. But anyway, again, it comes down to that. What are you actually buying the insurance for? And if you already have health insurance, you're paying a huge premium for more health insurance that you already have. Right. So always keep that in mind. Sit down, do a good inventory of what you're paying for in insurance. Make sure you're not doing it just because your dad did it or whatever. Make sure you're doing it because it makes sense from your budget. Any questions on that? Victor?
Does auto insurance typically cover when you share a car with other people?
Well, we'll talk about that. If you do it once or twice, your Part D is covered. If you do it all the time, your liabilities can become an issue. So there are times to be careful. You can't, like if someone has a 16-year-old kid and they just have the kid drive all the time, but they don't buy auto insurance on him, the insurance company is not going to like that because you're paying a premium that's much lower than the risk you're taking. If they do it once and have a wreck, you're probably in trouble if it's a 16-year-old driver. So yeah, I mean, the insurance companies don't like it when people try to save premiums by just not saying who else driving the car because that changes the risk quite dramatically. We'll talk about rental cars. That is an issue. You're driving somebody else's car yourself. You rent the car. I don't buy the rental car insurance. It used to be pushed pretty heavily. I don't know if you rented a car recently. They used to push it really heavily. They don't do it much anymore. They tend to exaggerate the need in the past. But there are times where you get free coverage if you buy it on the right credit card, those kind of things. So you always want to be aware of that. And we'll talk about driving outside of the United States. That creates all kinds of risk. All right, let's get into this wacky question. So here, make sure you're taking really good notes. This is a question on the first exam. It's one of your essay questions. And if you wait to think about it before the exam, you're going to be really sad because you're going to have to rewatch this entire class. I will give you a rubric for it to help you with it. But we want to talk about the capital asset pricing model. Good old William Sharp from Stanford. Here's his website. It's a great website. Some really, really good articles. I don't know the last time he's put an article out there, though. It's probably been a while because I think he's retired from Stanford. But I use a lot of these articles. He spoke in San Antonio many, many years ago. He's getting up there in age now. Really interesting. My boss's boss was there and he asked William Sharp, what are you working on now? I mean, this is the Nobel Prize winner in economics. And he said, I'm kind of getting out of finance because the math is just going over my head. I'm thinking, well, why am I in finance? Because it was kind of scary. But he came up with the capital asset pricing model. Not the best named theory out there because capital asset implies stocks, bonds, real estate, commodities. But what do we use CAPM for? Stocks. It's the only thing we use it for. It shouldn't be capital assets. It should be stocks. It says it's a pricing model, but it doesn't price anything. It gives you a discount rate so you can price stuff. So it shouldn't even be pricing model. It should be discount rate. It should be the stock discount rate. And it's not even a model. It's just a formula. So it should be the stock discount rate formula. Does that spell anything? SDRF. So it doesn't spell anything. So but that's what it really, really is. But that's the key. It's the discount rate you come up with a stock. Now, how many of y'all have had CAPM? Daniel, a few of y'all? Why isn't every hand up? Actuaries had it, haven't you? Have you had CAPM? Did y'all take 3013? You should have had it in 3013. So I know Beverly had it. She's going to say yes. Who else has had me for 3013? Are you only one? So you should have, y'all remember 3013? It's like 7 years ago. So you should have covered CAPM. If you're a finance major, you're getting CAPM in every single finance class. You get it in 3013, 3033, in Cat Beckham's class. You get it in security analysis, right? It just comes up over and over again. So if you haven't had CAPM, you need, I know it's on the actuarial exams on the investment part. It's a big part of that exam. It's a fairly easy formula. Let's see if you remember from the formula itself. What does KE stand for? Discount rate for equity or for stocks. I don't like the word equity. I prefer stocks because if you buy real estate, that's also equity. Just means you have ownership. I prefer to say stocks. But the KE means the cost of capital for equity. It's a risk-free rate. What is the risk-free rate? Well, we normally think of the risk-free rate as the 10-year treasury yield. Right now, that's about 4.5%. So you can pretty sure if you buy a 10-year treasury today, you've got 4.5% locked in next 10 years without any risk. If you can't make at least 4.5%, then you might as well just buy the treasury. Why take risk to make 3.5% when you know you can make 4.5%? So then we have to add the risk premium. The risk premium includes two pieces. One risk premium is the risk of being in the stock market. We call that the market risk premium. Is it starting to come back to y'all? So what did your other class call it? The equity risk premium, maybe? You might have seen something like this. Does that look more familiar? All right, I don't do it like this because it's not done like this in practice. The return on the market minus the risk-free rate is the market risk premium. So if you're a finance major, you can forget this. We just combine it and say it's the market risk premium. If you use in an interview, you talk about the return on market minus the risk-free rate, they're going to look at you funny because we don't do that anymore. But that's probably how they taught it in your class. But this, the return on the market minus the risk-free rate is the market risk premium. So that's just the risk of being in the stock market, period, because stocks are riskier. But what about an individual stock? Well, now we're going to adjust that with something called beta. Now, who's had beta? I assume you've all had beta, right? If you've had me, you see my weird way of doing beta. So beta for the market is 1. Right? So what is beta measuring? If your beta is 1, then you're just going to get your return that you need from the stock is just what you expect on an average stock out there. You're not risky or not less risky, you're just right in line. So the real key for this exam question is you got to start with this. Beta is a measure of non-diversifiable systematic risk relative to the market. In your essay question, you need to give me the formula and you got to explain clearly what beta is measuring. The beta measure is systematic risk. So on your essay for exam 1, you want to talk about systematic risk and unsystematic risk. It's really critical to this answer. Total risk is the sum of those two risks. The total risk of a stock is just a standard deviation. How does its stock price move? That's total risk. That includes systematic risk and unsystematic risk. Next class, I'm going to actually show you how to calculate that, remind some of you how you did it. You did it probably in one class. I don't know if you remember the graph where you had all the dots and you put the trend line in there. That's the beta. I'll show you that. But that's total risk. 100% of risk of a stock is a standard deviation and split. Now, oh, sorry. Probably it's a spam call. I should probably take it. So some of a stock risk is systematic, which means it's sensitive to the economy. If you're in a recession, it's going to do really badly. If the economy is doing well, it's going to do really, really well. Maybe really sensitive to interest rates or inflation. That's systematic risk. It's those risks that affect all companies. Unsystematic risk, the definition is down here. These are risks that you can easily eliminate by simply putting a bunch of stocks into your portfolio. These are company-specific risk. All right. So some risk a company has when you buy a stock, they're sensitive to the overall economy, especially a recession. Cyclical stocks have a lot of really high systematic risk. Defensive stocks have really low systematic risk. Oh, they even left a voicemail. Good. Unsystematic risk might be you have a pharmaceutical drug you thought was going to get approved and didn't get approved, and the stock market crashes. because it can get approved. A good example is the weight loss drug. The company in, I guess, in Sweden, they had a new drug that was going to work really well, and it came out, it didn't work that well. Their stock price plummeted. Eli Lilly's stock price went up. Why? Because Eli Lilly was worried this new drug was going to take their business, and it ended up not doing that well. So if you had Eli Lilly, and I forgot the name of this other firm, it'd come to me after class. But if you had both of those in portfolio, you'd lose on one, you gain on the other, because it's company-specific risk. Maybe today what happened with NVIDIA, maybe that's a company-specific risk. You know, they're competing on AI. There's a company in China that's doing really well. That's company-specific. That's somewhat well-diversified. You might say, well, but didn't all stocks fall today? Did all stocks fall today? Anybody here in my investment class? Did all stocks fall today? Y'all see any green today? I see a lot of green today. Every stock didn't fall today. Yeah, NVIDIA fell today, but CRM was up 4%. Apple was up 3%. Meta was up 2%, even though Google was down 4%. Walmart was up 3%. Eli Lilly up another 3%. So you say, well, the market was down 1.5%, but about half the stocks in the S&P were actually up. Why was the market down? Because some really big stocks were down a bunch. There was a lot of others that were up. So there is a lot of unsystematic risk. If you were to think about the percentage, how much of a company's stock risk is systematic versus unsystematic? Any guesses? I might next class show you how to calculate this because it's really, really pretty cool. But what do you think the most of the risk is? It systematic or unsystematic? What would you guess? Most students say systematic. What's the right answer? It's usually about 20% systematic, about 80%, which is really good news. That means when you put a portfolio together, 30, 40 stocks, 80% of the risk of the individual stocks just disappear, completely go away. I'll show you mathematically how I calculate that. It's actually a really, really easy calculation that you should know how to do because it's really simple. So that's kind of the nice thing from William Sharp's standpoint is when you're building a portfolio, you don't have to worry about standard deviation of the individual stock. It could be a really, really risky stock, but if it's a really risky stock, but it's up 10% during a recession, that's wonderful because you actually want it to be really risky. You want it to be up 10% during a recession because it's going to offset the other side. And he says most of the risk of a stock is unsystematic. So when you look at the risk of the stock, you don't look at a standard deviation. You look at its beta, which beta tells you how sensitive its systematic risk is versus the average stock. If the beta is 1.4, if that's Google's beta, that means Google has 40% more exposure to systematic risk than the average stock. What would you think Kroger's beta would be? Is that a high sensitive stock versus the economy or low? What beta would you expect? 0.47. So that means Kroger is going to protect you in a recession. People go grocery shopping in a recession. They may not buy as much advertising from Google in a recession, but they'll go grocery shopping. All right, so we'll talk more about this. I'll show you how to calculate some of these numbers so you can get some practice, but make sure you're taking really good notes, all right? Don't waste your time as a student in class. You got to write this essay, write it in class, right? We did that last semester, didn't we? Beverly wrote that entire massive second paper in class as a class. So write your essays while we're going through it. Don't wait before the exam. In fact, I'd encourage you to get it all written, finish it, and come talk to me before the exam so you can make sure you don't have anything major. All right, we'll stop there. So last class, we were going to talk capital asset pricing model. We'll bring that back maybe Monday. I don't know if we'll get to it tonight, but I do want to talk to articles so you can get paper one going. So what I want to do is walk through the article again, make sure you're understanding all pieces of it, and then do a real detailed outline of it so we know exactly the key is to have the level of detail that makes sense for this topic because the details are really important in this topic, understanding of what he's trying to say here. So you start off with what is float and what is the cost of float. What is float is a really tough thing to get in here. So if you think just from the things we're talking, I'll give you some high level things you probably want in your paper and you have to put it into your own words and struggle with it. I think this first part can be the hardest part because it's a little tough. So we start off with what is float, and there was a few aspects he brings up. He says it's money we have but do not own. So he starts with that definition. I don't think that's a really good definition. Our money we hold but don't own. So money we hold but do not own. So that sounds like debt. So float and insurance is like debt. It's not exactly debt, but it's like debt. He really is saying he views his policyholders as sources of capital that are pretty cheap source of capital. Another real important concept of float is timing. Premiums received now, claims paid in the future. So that's a really important concept. What he's saying, there's a timing issue here. Sometimes that timing is pretty quick. If you're doing auto insurance, we're talking 1 year to 1.5 years. It's pretty quick. You buy auto insurance, you pay the premium for 9 months or for a year. And if you have an accident, they're going to pay you back pretty quick. Some of it can be really, really lengthy. We'll talk about asbestos insurance. That can be 50 years, 60 years between when the premiums paid, when you actually pay out the claim. So the time, so you might think in terms, you don't need this in this paper, but you can think in terms of short tail lines and long tail lines. What that means is there's some products that the timing is pretty short. You really don't have much time to invest the money because you're going to pay it back pretty quick. And there's other times where the timing is really, really lengthy. And we'll see both of those. Usually on the personal side, the kind of insurance we buy, it tends to be pretty short term. Homeowners, auto, it tends to be pretty short term. Some of the commercial side can be very, very, very lengthy. The company I dealt with, USA, it was all short tail lines, very short term. But there is a timing difference still. It can be a year and a half, but there is some time where you get that money, which means can invest the float before paying claims. Don't make sure in your definition, I've seen some students say this, that float is the investment. So float isn't the investment. Float is that money that you get from somebody that you're going to have to pay back in claims. What do you do with that money? You invest it, but you're not saying the float, you're investing the float, but the investment is not the float. So be careful. Another aspect he talked is how you measure it. And he made it pretty clear. It's the reserves on the balance sheet. He actually gives numbers. Our float for X year was $18 billion. He gives a number. And when he gives that number, he's showing reserves. I don't know if he actually says it clearly. He uses the word reserves, exactly which reserves he's talking about, but these are the actual reserves, $35 billion. He's saying that's float. Why is that float? Because that's what a reserve is, what you expect to pay out in the future. All right. So your claims, and we're going to see this, we're going to study Schedule P. When we look at Schedule P, it's one of my favorite parts of the financial statements. There's 2 parts of Schedule P, or 3 parts really, but the parts we're going to look at, one is how much in total you expect to pay in claims. And the second part is how much you've already paid. So for our auto insurance that we sold in 2023, we ultimately expect to pay $10 billion. So far, we paid $8 billion. So what would you think the reserve would be? Be $2 billion. So the reserve is what you still expect to pay. Now, if they say 35 billion is reserve, they may have paid out 45 billion, 60 billion for that product. In total, that's what they're going to pay out, but they haven't paid out all of it yet. So ultimately, they're going to pay out 45 billion, but they've only paid 10 billion so far, so they still have 35 billion left. That's what he's calling float. And I don't think he's as clear on it as we'd like to be. Float arises, there he has the timing. You see the timing? Float arises because premiums are received before losses are paid. So there's an important timing component. And he says the interval that sometimes extends over many years. What he's talking about there, a long tail, there's long tail lines. There at that time, what do? You invest it. So he's not saying the investment is the float. He's saying you're investing the float. Then he says something that I said I somewhat disagree with. The premium that an insurer takes in is usually do not cover losses and expenses, but we saw with auto that it almost always does with plenty left over. You remember the combined ratio for auto around 92. So they take in 100 and only pay out 92. That's pretty good. That brings up the second topic that you need to talk about, and that is the cost of float. And here, I don't think he uses the word combined ratio. Well, especially if I misspell it. Yeah, he doesn't use the word combined ratio. Yeah, I can't search on the word ratio because he uses operations. It's only used 5 times, so. He uses the loss ratio. The loss ratio is just the claims part divided by premiums. That we saw with auto insurance was about 70%. So you give them $100, they're going to pay back $70 to you, and they're going to spend $22 on expenses, and they'll have $8 left over for profit. All right. So he talked about the loss ratio, but I don't think he uses the combined ratio anywhere. So we're really, really far back. That. But I want you to use the word combined ratio and explain it. All right. That's what I was saying is all you do is summarize the article. You're going to be missing some pieces. There's stuff you have to bring into this. Like the reserves is a good example. He talks about reserves, but he doesn't say it explicitly. I want you to say explicitly. So there's some places I want you to explain it better than he did. So the combined ratio is the loss ratio plus the expense ratio. It ignores investment returns. No, he's not saying the combined ratio is the cost of float. He's saying the cost of float is inflows minus outflows. What is the combined ratio? Combined ratio is outflows divided by inflows. So if the combined ratio is below 1, your cost of float is actually negative. You're actually, and he uses that phrase, right? It's like you might put this in your paper, it'd be a astute way to do it. Where he says you're actually paid for holding other people's money. Y'all see that at the top of page 7? We've actually been paid for holding other people's money. That'd be a good way to bring the combined ratio in. How do you measure the cost of float? In class, we talked about something called the combined ratio, which is the loss ratio plus the expense ratio. If the combined ratio is below 1, that means we took in more than we paid out. As Warren Buffett said, Sometimes we've actually been paid for holding other people's money. You could bring other things in class. We looked at Progressive's auto insurance, where their combined ratio was always below 1. And so quite frequently, they had a cost of float that was negative. Is that sinking in? So you talk about the cost of float. Then what you're going to talk about is the underwriting principles. How do you get to this part of the paper? So I do look at clarity. How do you get from one section to the other? What he's talking about is how to control the cost of float. That's what he's talking about, underwriting principles. We use the word underwriting quite a bit in insurance, especially on the property casualty side. But underwriting really means that loss part of the business, that loss ratio, making sure we don't pay out a lot more. The expense ratio is pretty stable and pretty predictable, but that loss ratio is pretty big. Now, the loss ratio does include loss adjustment expenses, so we won't get into that so much. But it's not all of that loss ratio goes to the customer. Some of it goes to the adjusters and lawyers. Now, he says there's 3 principles. I say there's more than 3 principles. So if you look at the paper description, I say there are 6 principles. He says there's 3. I say there's 6. Which should you probably have in your paper? Probably 6 would be a smart thing to do. So the first one has a couple of them in there. And so if you look at our list, it might be a little easier to look here. First of all, and they may not be in the right order that he has them. You can change the order around. The first one he gives is able to evaluate them. You have expertise. Make sure. So I hate to change the order, but able to evaluate, have data, and here be very, very specific. I'm not sure he uses the terms frequency. He does use it once. That's the only time he uses it. And severity, he uses that twice. That's on page 46. So not in the part you're reading. But you should have frequency and severity in your answer, most definitely. And where does it go? It goes in that part. When we're talking ability to evaluate, we're talking about frequency and severity. And give the definition. Remember, frequency is the number of claims, severity is the average claim. Right? Give a clear. So frequency and severity, very, very important that you have that concept in this paper. So what are you evaluating? What data are you evaluating? Well, how many claims am I going to get? And how much will the average one cost me? Also, that evaluation includes properly evaluate. And that evaluation includes remote scenarios. Kind of changing order on you, so sorry, the rubric, my order, I'm going to change it. So you don't just look at frequency severity in normal times. You say, wow, every once in a while, maybe one in every 100 years, 1 in 500 years, there's something really wild that happens. So we need to look at that. Avoid remote loss possibilities or losses that can aggregate. So you've got a couple things there. Remote that can include aggregation. We'll get into correlation here. That's really what you want to bring in, the concept of correlation. That's what aggregate means. So make sure everybody's real clear what I mean by aggregate. So normally two things are unrelated. A happens, doesn't cause B's to happen, they're unrelated. But in a remote scenario, there are times where A and B become correlated because you're such an extreme scenario. So a good example was 9/11. He was insuring all these employers. The chances more than one of those employers had something serious happen at the same time was very remote. They're different companies, different types of workflows, and different different locations in the same building. But 9/11, suddenly all those employers became correlated because the entire building was attacked. And that was an aggregation. So aggregation, you could have one scenario that's just massive, or you could have one scenario that becomes even more massive because certain things that weren't correlated, suddenly become correlated. So there's certain words you definitely got to make sure are in your discussion that you may not see in his. Now he does use the word correlation in that one phrase I really love. So, if you want to try to work that in there, ceaselessly search for possible correlation among extremely unrelated risk. I love that phrase. Ceaselessly search for possible correlations among seemingly unrelated risk. It's hard to say, a lot of S's in there. So this remote loss is extended in the number 2, where they bring up this idea of aggregation. So they're able to evaluate it, and that includes remote loss possibilities, which also includes the aggregation of losses, because things that used to be uncorrelated suddenly become correlated in the extreme. All right. Sorry, I'm changing the order, but I do like this order better. Even after remote losses, still expect a profit. Now here, I think he's very, very unclear on this one. He says, even after remote loss, expectancy of profit. I want you to be real clear on this because I'm sure it's what he means. He's not saying not every year, but over the life of the product, it's profitable. He's a reinsurer. Reinsurers will lose money in some years. There's just no way to avoid it. That's just the nature of the business, because they're insuring huge amounts, but very, very rare events. So most years they make a lot of money, and then every once in a while they'll lose money. So make it clear, it's not that they expect to make profit every single year, but over the life of the product, you can have one bad year, but the good years should offset it. You still have a profit. That's the kind of analysis you need to be able to do. If you do an analysis and you say, well, there's a chance we have a loss that's so big that wipes out all of our profits and we lose money, then that's not a product you want to do. Walk away from business if competitors not pricing rationally. What word did he use? Do I remember that? Remember the word sanguine? What does sanguine mean? Indifferent or happy? So it actually means happy, right? He's actually happy to lose business. I doubt that's really true, but yeah, he's going to. Why can he see that? You might work this in the paper, just for me telling you, he knows he has an expense advantage. He knows his prices should be better than competitors. If their prices are lower, they're mispricing the business. They're hoping, because these are remote losses, right? You could misprice this business and be lucky and the big event never happens. And there are insurers that do that. In fact, you see that in Florida. There's been some companies that will go into Florida and intentionally underprice their homeowners, just hoping there's no major hurricanes. If there's a major hurricane, they go insolvent and they come back another day and try it again. There's firms that actually do that, really small firms. They say, hey, we'll charge 50% of what we should charge. If there's no hurricanes next 5 years, we'll still make money. Not a smart thing to do, but they're kind of playing Russian roulette with other people's money. That they leave it to the state to bail them out. So they're sanguine about losing business to competitors offering foolish prices or policy conditions. We'll talk about the experience versus exposure. So we'll do experience. But the last one's a gimme. Don't deal with ethical people. Just put that in there, and I don't really. You can almost just quote him on that one. Obviously, it's important, but I don't think it's unique to insurance. I think that's true with every business. So I think he's just throwing that in there, to say, yeah, we should only deal with ethical people. To avoid business involving more risk, no matter what, try to write good contracts with bad people doesn't work. So he doesn't want policyholders that are going to try to rip them off and act unethically and all that. So that's probably true with Walmart as well. So it's important, but it's not important to what we're trying to get out of this article. Okay, step back and look at this list. Are y'all comfortable with this list other than experience versus exposure? So you see how to flesh it out. There's parts in here that aren't in his article that you're going to bring in. That's really, really important. You understand my parentheses here, but that's important. All right, let's get really, I think it's my favorite part here is the experience versus exposure. If you look in the class notes, I do have a discussion on this. And this is the part, sorry. We see. Okay, so this part students leave out of the paper quite a bit. So experience, you got to define experience. So this really is a big part of the paper. Define experience and exposure. You can somewhat tell from what he's discussing. The experience is just what, one way you can think about it is your actual historical frequency and severity. That's what your experience is, your actual historical data. Maybe your data or other people's data, but actual frequency and severity data that you have, whether it's your business or somebody else's. That's what experience is. Exposure is what you are promising to pay that might or might not reflect history. So exposure is what you're promising to do. I promise to do this. Your expectation is that it's being somewhat related to history, but that's the promise you made. So give a definition. And then you need to talk about when experience can harm you. Maybe a better way to say that when reliance, maybe I should say over-reliance on experience can harm you. So this is probably the number one thing students leave out of the paper. So I want to make sure y'all get it. I actually want this class to do better than previous classes. I grade myself on how well the class does versus previous ones. If you do better, I must have done a better job. If you do worse, either I did a worse job or you're just not as smart as the previous class, but I can tell this class is smarter than previous classes. So that can't be the case. So it'd be all my fault, but I still want you to get this. So it's in the notes. So if you look at the class notes on page 7 at the bottom, there's 2 ways experience can hurt you. One is where there's just not much experience. We're talking very limited data, very low frequency. So that's one. I'm going to copy this in so we don't have duplicate. You don't have 2 sets. So not much experience. What you want to do is, if you look at the rubric, you want to discuss experience versus exposure, and then you want to give examples of where experience doesn't work. All right. So there's quite a bit here. My rubric doesn't really tell you everything you need. So make sure you're clear on here. So define experience, define exposure, and then when does experience harm you? And you look at his write-up. Experience, of course, is highly useful. I'm not saying you should ignore it. It's important writing earthquake policy, know how many quakes have been in the state. At certain times, however, using experience as a guide to pricing is not only useless, but actually dangerous. So that's what I mean by over-reliance on experience can actually be harmful. I'm telling you, there's two ways it's harmful. He doesn't. He implies it. It's kind of implied between them. You have to be real explicit on this, all right? Actually put in your paper the two ways experience, over-reliance experience can harm you are. And do number one, number two, all right? So you make sure that's clearly in your paper. Some students completely miss that in your paper. And what are the two ways? The first way is there's just not much data. You're talking very rare events. Earthquakes is a good example of that. So you do want to give an example. If you can give other examples, you'll get more points for critical thinking, for becoming a better example. So earthquakes is a good one. What's another obvious one, though? The one he's talking about, terrorist risk. Right? That's exactly what, and I can't spell. Bill Gates can't spell terrorist risk. Whether it's external, internal, or whatever, there's all kinds of scenarios you can come up with. It doesn't happen all that often. And it is a power log. Earthquakes and terrorist risk are both power logs, which means as you get to the more rare events, the losses really mushroom. So a 5 Richter scale earthquake is not nearly as powerful as a 6 Richter scale. And when you go to 7, you get really crazy. And when you go to 8, it's just massive. So it's a power log, really flips up. As the frequency comes down, the loss gets much bigger. I'll probably show you this page later when we talk about catastrophes. Someone actually mapped terrorist risk against earthquake risk, and they map very similarly, where it's very infrequent, but it's massive. So there's a lot of small terrorist risk that's not all that big. There's a lot of small earthquakes, don't cause much damage. But as you get to those rarer and rarer ones, the losses don't jump up, they store up massively, as we saw on 9/11. So if you can think of others like that, where they're just really tough to get the data because they just don't happen that often. The second group is we got plenty of history. We got plenty of data on frequency and severity, but the world's changing. What we saw in the past, we don't expect. So the most obvious one there is global warming or climate change. If climate change is causing ocean waters to be warmer, that's going to cause us to have more hurricanes. So they're going to be much stronger hurricanes. You're going to have more mudslides, more floods, more fires. Then definitely the historical data is not going to help you much on that. We'll look at some charts on that. When I look at, I can't show you that because it takes me long to find it. But we look at the NOAA site, the national, whatever, the hurricane, people who track hurricanes. If you look at their annual data, you can't really look at it over time and see, wow, the frequency is really going up. And there's some debate. I think part of the reason people talk about hurricanes going up is that before Hurricane Andrew, which was in 92, before y'all were even born, but in 92, we had a very long quiet period without hurricanes. It was just very quiet. So we gotten used to not many hurricanes. And then suddenly we had a bunch. But people who look really long term, that's actually not that abnormal. So it's hard to argue that hurricanes are higher now because of climate change versus we just had a really quiet period, now a noisy period. So we're still not there. We do know water temperatures are warmer. That does give you more hurricanes and they're stronger. But how do you change the statistics? So it's not obvious looking in the charts. We'll look at some of the charts and see if we can actually see those patterns changing. But Global warming, climate change is a good example. D&O he talks about. Anybody know what D&O stands for? So he defines D&O. I've never had to sell D&O, but directors and officers, I don't know if he defines, does he actually see what it is? So D&O is directors and officers. So this is the example he gives because when do stockholders sue companies? Is it after stock prices are risen a bunch or after they've fallen a bunch? After they've fallen. So what happens to D&O insurance? What's your experience if you just had a decade where the stock market's done nothing but go up? Very few claims. If you use that as your experience, what are you going to discover? Wow, frequency is really, really low. But that probably means, that's like in 1999, right? We had a whole decade and more where we just had stocks going up, going up, going up, very few claims. Well, now the stock market's real expensive. You have the dot-com bust, you have the 2008. Suddenly you have two massive events in a decade. What did all that experience in the 90s do for you? Made you complacent, made you misprice the insurance, and suddenly you have these major events. So he's using D&O after the stock market. He talks about these great bull markets. Your experience is great. You're tempted to cut your prices on D&O, but that may be when the risk is the highest. Because the stock market is expensive, it's likely to crash. You can get a lot more lawsuits. So when stocks falls, these sins surface, hammering investors with losses that can be turned into billions. Juries deciding whether those losses should be borne by small investors or big insurance companies can expect to hit insurers for verdicts that bear little relation to those delivered in bull market days. So he uses D&O. D&O fits better with the second one because the one he's really focusing on in this paper is the first type, the terrorist risk, where you just don't have much data. So, try your best to come up with something. I can sit here and think of other ones. What about volcanoes? Hurricane Ellen, y'all don't remember that, but that was kind of a surprise and it caused some pretty serious damage. But if y'all can think of others, you'll definitely get some extra critical thinking points if you can think of others that would fit in those two categories. Are you clear on the categories? Limited experience, experience is changing. Are y'all going to have these two in your paper? If these be the first class, will it be 100% of the class? Someone is going to write their entire paper reading only this, and they're going to miss all of that. So somebody will. Who is it? Does anybody want to volunteer their neighbor that they're going to do it? So we'll see. Now, what does he say about this first one then? You can decide if you want to work more of this. He does say what we do know. And here he's talking about terrorist risk. So he say, okay, we don't have much data. It's really hard risk to insure, but we do know some things. Now, I'll question if we really know some of these things, but you can see if you agree with them. What do we know? The probabilities are not zero. So what's the chance someone could, and I hate the, horrible disasters, but someone could drop a nuclear warhead in New York City, right in the middle. What's the chances of that happening? Is there some group out there that has their hands on that type of technology that they could do something, or some bubonic plague that could drop in the middle of New York? Why New York City? You got a lot of people all in one place. It makes a lot easier in Los Angeles or something. I do have a student. I'll probably bring this from our risk class. He works for the city of New York. I may mention that in here, but just incredible. He came up with a list of risks they should worry about. He actually had earthquake on his list, and that was well before New York had the earthquake. So I'm in meeting to email him and say, man, you got that right on. Because when I read his paper, I was like, give me a break. You're talking about earthquakes in New York City. That's no one worried about that. And then so, a few years later, they had earthquake. But that was his point is it's not zero. We do have a fault line. It can happen. So it should be something we're aware of. So even though the probabilities are extremely low, they're not zero. Okay, well, that's one thing we know. The second one I question, he says the probabilities are increasing. Now, what happened after 9/11? We became much more diligent, didn't we? We changed how we, TSA screening, getting on planes. There's all kinds of things that we've done. Is that true? I don't know how he knows. How does he know that? Isn't it possible the probabilities are actually declining because we're much more aware and much more focused? Who knows? But that increasing probability is irregular and immeasurable. I do think that is true because I do think there are groups that if they want to harm us, they know they can be pretty patient. If they got to wait 10 years before we become complacent again, I think some group says that's fine. We'll wait 10 years to do that. Knowledge materials become available, so their skills would get better. One thing I think we have to worry about is our infrastructure. Someone being able to take down all of our energy so we're without electricity. What would happen in the United States if we had no electricity for a month? We would pretty well die, wouldn't we? Can you imagine the lines at HEB for canned goods? It'd just be, you have to be the first person there and you have to be pretty aggressive. Could someone do that? Who knows? We've had some pretty serious attacks on our infrastructure, so who knows? Fear may recede, but danger won't. You can never win this war. The best a nation can achieve is a long succession of stalemates. But I don't know if that's necessarily true. I think it's more of, I would probably say the probabilities may be increasing, or the probabilities will increase once we become more complacent. Our complacency is probably inevitable. I do think we become comfortable over time, but so there's other ways I would have written it. All right, now he uses the word blithely. I think blithely means indifferent, whereas sanguine means you're happy about it. But let's see if I'm learning from Warren Buffett here. Casual, cheerful indifference. So the sanguine, he was happy to lose business. When it comes to writing these really bad policies, insurance companies did it without really much thought about it, without much really serious contemplation. So we blithely, indifferently assume these consequences from these incalculable risks. Kind of violates that very first principle. Don't insure things you can't put numbers to. His last one, excuse me, his last one is true. There are scenarios out there that will completely wipe out the insurance industry. We're more worried about those on the earthquake and hurricane side, but he's talking about that on the terrorism side. USAA, State Farm, Allstate won't get wiped out because they don't sell that type of insurance, so they don't have the issue. But the big commercial insurers like AIG, Berkshire Hathaway, they could be really destroyed. Who's the only entity that can handle that? Be the U.S. government. So he's kind of hinting that the U.S. government needs to step in and take on some of these losses. So the industry has these issues. Auto doesn't really, I don't know, anyone's really worried about a major catastrophic issue for auto. There are some concern about autonomous vehicles. We are all driving autonomous vehicles that someone's going to tap into the software and just have us all crash into each other all at once. I think that's still a ways off because I doubt any of y'all are driving autonomous vehicles yet. But right now, it's hard to find a scenario where a bunch of cars just get destroyed all at once. Homeowners with the earthquake and hurricane, you can definitely, and the fires in California, you can certainly see big events. But he's talking on the commercial side, and especially these, you're insuring this multi-billion-dollar building, many employees inside. Those are large losses all at once. USAA, the hurricane side, I remember seeing losses of $3, $4, and $5 billion just for USAA. Pretty massive events. So it's most of the property casualty side has something other than maybe auto in that. You might work some of this in here, but that's what you'll see where he's talking there. He's really referencing back to this first one here. We don't know much, we don't have much data, but there are some things that we know or we think we know, and that's where that list of 4 comes in. Right. So most students do okay on the first 4. And if I were to look, I should probably tell you the score from the last time I saw one of these. This part of the paper was probably well below 50% credit. So a lot of students were missing this. So hopefully this is the first class that doesn't. you're not sure, come show it to me, and that's one of the places I'll look out real carefully to make sure you have it. But you're gonna make sure you have these two bullets there. Now, where does he go next? The next section is not part of this paper. It's something we'll get to later. He's talking about loss reserves. So that's just a reserve. So I'm not gonna make it part of the paper. But those are just, that's that float. So we talk about the float. If you want to bring it in, that's fine. It probably won't get you any extra points. But the point he's making is we under reserve already. No reason to discount reserves. I disagree with him on this in two aspects, but he's saying, I forget exactly where he says it. It's somewhere in this section. Yeah. So he talks about we didn't reserve correctly. We didn't set up enough reserves. So he's making fun of actuaries, but he uses this term reserve strengthening. And I can't spell strengthen. It's got a G and an N in it somewhere. And Bill Gates can't figure it out. Strength. Y'all know how to spell strengthening? Strength. NG. There you go. Oh, so close. All right. Reserve strengthening. That sounds really good. Hey, we're doing some reserve strengthening. What did Bill Gates, not Bill Gates, Berkshire Hathaway call this? He called it oops. What does reserve strengthening mean? We did not forecast losses correctly. Now he had more. He calls it oops. I think I can probably insert some of the word oops in here. Not knowing your costs will cause problems in any business. Essentially saying the actuaries sat down and say, yeah, I think we'll pay out 5 billion, and they end up paying out 8 billion. And so they have to add more to reserves. Well, I'll talk about this with asbestos insurance. There's a firm called CNA. It was a big insurer of asbestos. It's kind of interesting because Warren Buffett actually bought the asbestos risk from CNA. They paid him off to take the risk. But a friend of mine analyzed that industry, and he remembered at the end of the year, CNA said, we've strengthened our reserves. We're good now. We think we've covered ourselves really, really well. And the next year, they added several $100 million more dollars, hundreds of millions of more dollars to the reserve strengthening. So in just 1 year, they thought we got it. The next year, way off. Does that mean their actuaries aren't very smart? My guess is their actuaries are very smart. It just means the risk is really, really difficult. We'll see with asbestos. Y'all have heard of asbestos, but asbestos causes cancer, but it may not cause cancer for 20, 30, 40 years. So the actuaries have to set up a reserve for people who will get cancer who right now don't know that they will get cancer. So that's called incurred but not reported. It's a really tough thing to figure out. You got to figure out who's going to file a claim who had no idea they even have a claim. And you got to put that into the reserves. So that's what he means by reserve strengthening, is you made a mistake. So it somewhat relates to the previous part, but it's just showing you that when you're calculating a float, it is an estimate, and that float calculation can change as you get better information. But where do I disagree with him? He says we, the industry, under reserve. Our reserves are understated. I think when we look, we're going to look at Allstate and look at their Schedule P. And one reason I love Schedule P is it tells you how bad the reserves are. I wish I could show you Schedule P now, but we'll look at it. It's one of my favorite schedules. But what it does is it says, okay, for our business we wrote in 2015, in 2015, we thought this is what we're going to spend. But in 2016, now we thought it was this. So you can actually see how they change that reserve over time. And what I've noticed, especially with the firms I've seen, is it's pretty conservative. If anything, they over reserve early, and they do what they call release reserves. What does that mean? You can kind of tell, right? Man, I can't spell anything. Release reserves. You reserve too much and you let some go. This is the conservative. You're conservative. Now, USA, boy, I wish I could find Mary again. She was the reserver at USA. I worked with her several years there. She was tired of seeing me coming every time I came over to her desk. She thought I was asking questions from our project, but I was just trying to learn everything I could from an actuary. But she had a cushion in her reserve of about 2-3%. She intentionally over reserved about 2 to 3%, and she knew it. And if you looked at her reserves over time, as they got more information, it really did come down about 2 or 3%. And I think that's pretty normal for most firms. So I'm not exactly sure where Warren Buffett got this, other than he's cynical and negative. I think he's thinking more the asbestos side, the professional liability, those places where they were shocked with some really big events and didn't have the reserves there. But auto, homeowners, I think the industry is actually pretty conservative. And that's when he brings up discounting reserves. So he says, so if you think you're going to pay out these claims over 10 years, can you take the present value of that as your reserve, or do you actually use the future value? He's arguing no discounting. I think that's crazy if you're talking about asbestos. If you're going to pay, you have claims you're going to pay out over 50 years and you don't discount it, that's just going to wipe your whole business out. You know, y'all know how big numbers are over 50 years. If you don't discount that, that's just going to make your business look really unprofitable. So I don't think that's possible with long tail lines, but that's what he's saying. But that's essentially what he's talking about on this page. I had you read it, even though it's really not part of this part. It's not part of the economics, but I want you to read it because it will come up later when we talk about Schedule B. I don't know if I did a search on oops. I think he says oops in here. Oh, here it is. Is that the same page? A more forthright label for the phenomenon. So here he says, so loss development, that's the other thing he talks about. That's just how losses are forecast as more data comes in. Loss development, he says losses don't develop. They are what they are. Our forecast and understanding of loss, that's what's developed. The losses are there. They are what they are. So he's making fun of actuaries here, which is fine. You can make fun of actuaries every once in a while. Just don't challenge them to a math quiz. But so the losses didn't develop. They were there all along. What developed was management's understanding. A more forthright label would be loss costs we failed to recognize when they occurred, or maybe just oops. Under reserving is common. I don't know his business as well on the commercial side. Maybe it's common on the commercial side. I don't think it's common on the personal side. We told you of our own problems with underestimation before. Our reserving has been conservative. Major unreserving is common in cases the company is struggling to survival. Now, he does say if a firm is really struggling, they may have an intention to under reserve. These firms are audited, and the auditors have actuaries. It's not like there's a bunch of accountants trying to figure this out. You have to have an actuary working for Pete Marwick or whoever. You can't just under reserve and get away with it. So the auditors are going to test that. They're going to do their own tests. But you might be pushing envelope as much as you can to get around what the auditors are going to do. So there is that debate. So if you do that, you may not get a clean opinion from the auditors. So they have that risk. All right. Then we'll talk. Where is the a G. All right. So I may not have given you that part to read, but I can't remember. I've told you to go through. I told you to go through page 12, right? So yeah, that loss development sides, it's on the last page. All right. So what else do you need to do in this paper? you're supposed to talk off of page 10. I want your honest opinion based on first impressions. I really want you. So really the way I want you to read this paragraph, and I'm probably gonna mess it up now by reading it now, is think back to what he has said. Those 6 principles. Only insure what you can, consider remote losses, worry about unintended correlations, and then you get to this paragraph. Since September 11th, Ajit has been particularly busy. Among the policy he's written are, and then he lists these policies. What's one way to make something that's uncorrelated suddenly be correlated? Maybe list a bunch of things on the same page all together. Maybe could that maybe is you're some terrorist saying, man, what could we attack? Oh, here's a list, right? That seems interesting to me. But look at the way he's doing it. If I were he, I would have set this sentence up much different. Now, I had students say, no, I think it's clear the way he's done. So think of it as a stockholder, you're investing in this firm. He just told you, we messed up in 2001. We didn't follow these principles. But here's what we're doing now. We're doing 578 million in property coverage for a refinery in South America. We're doing $1 billion in liability coverage for acts of terrorism on airlines, 500 million pounds in North Sea oil platform from terrorism and sabotage, 600 million retained or reinsured elsewhere, so they're having others help them with it. Sears Tower, including losses from terrorism. Y'all know the Sears Tower? I forget what it's called now. It's like Watson or something. Someone looked that up. What is the Sears Tower today? It's something different. Have y'all been in the Sears Tower? Any of you? Anyone?
It's Willis Tower now.
Willis, that's right. Yeah, Willis Tower. Yeah, I don't recommend it if you don't like heights, because it's very narrow at the top and it sways 18 inches. I had a dinner up there with bankers, and they thought, this is cool. We're going to put you at the top of the tower. And I was like, I can't wait till this dinner is over. I was dreading the elevator ride down because I have a horrible fear of heights, but we were up there swaying in this little bitty room at the top of this 100-story something building. It was terrible. But they evacuated the Sears Tower at 9/11 because they're worried about other attacks. So, you know, definitely, and it was taller. It's taller than the Twin Towers. So insuring the Sears Tower. And then he says, we've done many other jumbo risk as well. I mean, it's like, let's find whatever word we can to make it sound as massive as possible. Jumbo. World Cup soccer tournament. 2002 Winter Olympics. I went to the 2004 Summer Olympics as a spectator, not as an Olympic, but we were worried about terrorism there because it was kind of the first major event after 9/11. And maybe in the 2002, I can't remember. I can't remember. But I tell you, when we were on the subway in Athens and we were like sardines, I'm thinking, if you're going to strike and try to knock out a lot of people, this is the place to do it, because it was, and I don't know what the protections were. So we thought about it. The stadium wasn't much of a place to, because once the last Greek athlete finished, the stadium emptied out. There's like 6 people there. When the US won first, second, and third in the 400 meters, we were like the only 3 people cheering. Like, hey, go. So I don't know what they did on TV to make it look like there were people there, but it was pretty hilarious. That last Greek competed and just, it was packed, and then nobody. But the subway rides, there were some places on the Olympics that, and so we talked about it before we went. You know, do we really want to assume this risk and do that? But World Cup soccer. When's the first time he says we're still following our principles? Not until here. In all cases, we have attempted. And he doesn't even say we have avoided writing groups. He says we have attempted to avoid. Makes it sound like, yeah, we think we did. We may have made the same mistake again. So I'm kind of biasing you on this part. You can take his side if you want to. Obviously, he's a lot smarter than I am, so maybe you should take his side. But that's pretty wimpy wording. We tried. We may have messed up again. We will not, for example, write coverages on large number of office and apartment towers in a single metropolis without excluding losses from both nuclear explosion and fires that would follow. I like this next phrase. No one can match the speed He can offer huge policies. Does that sound like the guy who wrote the other, that's 8 pages or 4 pages? After 9/11, his quickness to respond has become a major competitive advantage. So too is our unsurpassed financial strength. So anyway, you see what I want to do there is, these 2 paragraphs make sense given everything you just read, right? I'll leave that up to you, but put some thought into it. And Ajit's a pretty important guy if you want to talk about a replacement for Warren Buffett. And then your last thing is your own research. So one thing you could definitely do is just type Warren Buffett and float, and all kinds of things are going to come up. What you're trying to do is find something unique to add. So can you find some new perspective, something that, so it's been 20 years since he wrote this. It's still the best that he's written. So the ones he's written after that. So 9/11 gave him a really unique opportunity to talk about the insurance business. As horrible as that event was, it gave him a chance to really give us something. And so I like the way he wrote it here, and he just doesn't do it as well in the other ones, but he does write about this in his future annual reports. So you might find another one where he adds something unique or different, and that's what you're looking for. You might do that research on underwriting cycle. We talked about that in class. There you will find web pages on your underwriting cycle. You could certainly work that in. What most students do here is, I did some additional research on, and what I found interesting was they just set it up at the end of the paper. So don't feel like the additional research, you have to do it and you have to find how to put it into the paper. You can, if you want to put it in other sections, just make it really clear when you come to your independent research, make it really clear that this is your piece. Okay. Especially if you work it into the existing template, make it clear that, hey, I want you to see this as the additional research. Now, how much should it be? I'm not asking you to go out and do an entire report on a long article, but make it a couple of paragraphs of something interesting, at least 2 or 3 paragraphs. Find something interesting. You can quote somebody, but there's no doubt if you type in float and Warren Buffett, you'll get all kinds of choices and things to look at. Don't forget things like YouTube. I think YouTube sometimes is a better source than just a Google search. I know they're both owned by Google, but you can do Warren Buffett insurance float, and you'll see stuff. You may even see Warren Buffett come up. Warren Buffett things, the insurance business and the float it generates. That's 1 year ago. Is Munger in there? Y'all know Charlie Munger passed away, right? So we're losing all these. I don't think that's Charlie Munger, though. It doesn't look like him. Insurance business prizes with float, and float is money that we hold but doesn't belong to us. So he's not saying a whole lot of new stuff, is he? But you might be able to find something in there. Buffett Insurance and Investing, it's about the float. Seeking Alpha. Seeking Alpha is a great site. Warren Buffett, how Warren Buffett achieves great returns every year, advantage of insurance float. So I'm not making this stuff up. This isn't a one-time article he wrote about and never came up again. This is a big deal to insurance. I thought it was a big deal at USA because we had a brand new CEO who had never been in the insurance business. He came from banking. And I remember I was in a meeting with him and the CFO of the insurance company, who was my first boss. He moved from my first boss to being CFO of the insurance company. And he absolutely did not agree with this concept of float, and that float produces investment income. And that investment income is part of it. He was like, he hated that. He says, we're not going to do that. And so I'm sitting there waiting for the CFO to correct him, and she doesn't. So I'm like, I'm independently wealthy. If he fires me, who cares? So I'll just tell him. I go, well, Bob Davis, that's all well and good, but the regulators require you to provide the investment returns back to your policyholders and the pricing. And he got really mad. He slammed his fist down, and he asked the CFO, is that true? And he goes, yeah, unfortunately, that's true. So he hated this. It'd be fun to see him and Warren Buffett debate this. His problem was the regulators already decided Warren Buffett's correct and have forced actuaries to consider the investment side of float. in their pricing. So it was a hot topic at USAA. He learned a lot about insurance really quickly. He's a very smart guy, so he figured it out pretty quickly, but he did not agree with that part of the business. All right, so can you handle this paper? Get it done this weekend while you're still thinking about it, so we can start working on that tough exam 1 essay questions on this. Where do you feel the weakest on this? Anybody's already finished their paper? No? All right, there is in the notes, there is a, there are notes, they're not exactly organized, so you can decide how you want to handle that. I'm not going to put this out there on Blackboard or Canvas, so you better take a picture fast if you want it, but it will be in the video for class. I've got us on there. Yeah, we did the video. So you can take pictures of the video. But it's not much different. The only thing different between this and the rubric is I changed the order on those 6 principles a little bit. All right. Let's get a little bit more into CAPM. Not really related to this, but there's probably a few pieces that would be there. So the capital asset pricing model, what does that tell us? Remember the question we asked, we're asking 3 questions. When should individuals buy insurance? And we said that's when it's low frequency, high severity, because the premium will be low and that's when you really need it. When should corporations, or why should corporations buy insurance? Not when, but why. So with the individuals, it's when should you buy it? With corporations, it's why should you buy it? And that's what we're talking about here. And then the third question is, when can insurers sell insurance? And that's the Warren Buffett paper. So this one's kind of the in-between, making distinctions between individuals and corporations. They're very, very different entities because of the capital asset pricing model. So last class, we talked about CAPM. You can definitely Wikipedia CAPM and get a good background on it if you haven't had it before. But CAPM is giving you the discount rate to value a stock, to value a company. And that discount rate needs to reflect the risk of the company. And that risk is distinguished between companies based on beta. Every firm uses the same risk-free rate, market risk premium, and then you distinguish between the risk of individual companies by the beta. Firms that are very risky, very cyclical have high betas. Firms that are very defensive, low risk have low betas. All right. Beta measure of that relative risk. Well, what kind of risk? So this is really important to your answer. Beta only looks at one risk, and that's systematic risk, non-diversifiable risk. It's the risk the company has that is exposed to risks that affect everyone. It's things like the economy, interest rates, inflation, geopolitical events. And I was going to show you, I don't know if I have time to show you today. I may have to do it next class. Maybe I have one set up. So let's see if I already have one set up. I can show you. Here's one. So I've already done this one. So here's Walmart's beta, rolling beta over time. So if you go into Yahoo Finance, you type in Walmart, very expensive stock. I don't know why their stock is so ridiculously high. When you look at this PE ratio, 40, does that sound like a Walmart? Walmart should be at 23. I don't know why Walmart's so ridiculously expensive. They've been doing really well. But here's their beta. You notice it says 5 years monthly. That just means using monthly stock data for Walmart, for the S&P 500. That's the calculated beta they have. That's just one 5-year period. What I do is I do rolling 5-year periods. And so what is the systematic risk of Walmart? And it's really quite simple. R squared of Walmart's returns versus the markets. That's 17%. What does that mean? That's the percentage of Walmart risk that is systematic. What's 1 minus 18%? That's the percentage of risk that is what? Company specific. I said some of that last week. Most of the risk of stocks is company specific. So that means when you put a bunch of stocks in your portfolio and you diversify your portfolio, 82% of the risk of the individual stock just disappears. Because if Walmart's struggling, Costco is probably doing great. They offset each other. So most of the risk of companies is company specific. That's the beauty of beta. You're eliminating a tremendous amount of risk by putting a bunch of stocks in your portfolio. All right. And you see how easy it is to calculate that? It's just the R squared of Walmart's returns to the stock market's returns. That's all you got to do. It's a really simple thing to do. So beta is only calculating that relative risk of that 17%. Total risk is the systematic risk and the company specific or unsystematic risk. But about 20% or so of the risk is, for most companies, is systematic. About 80% or so is unsystematic. Now, this does change. I'm going to talk about this in my risk management class. Unfortunately, in a crisis like 2008, the systematic risk portion jumps up to like 40–45%. In my risk class, we were talking about how the tools you use in finance work really, really well unless you need them, and then they don't work very well. So in a crisis, our risk tools don't work well. But in normal times, most of the risk is unsystematic. What is systematic risk? You can't reduce it by just adding more stocks to your portfolio. You know, if you have 50 stocks in your portfolio, you add another 10, you're not going to reduce systematic risk. The only way to reduce systematic risk is to buy lower beta companies. You have to specifically buy companies that are not as exposed to the economy. So if you want to reduce the beta of your portfolio, you don't add 10 more stocks. You sell some high beta stocks and buy some low beta stocks, right? So diversification does not reduce beta. You have to actually specifically buy them. The economy is the systematic risk of risk. That's how I think about beta. How will this firm perform in a recession? Well, do above average or below average. If it performs above average, then it's defensive. Has a low beta, it's going to perform below average. It's cyclical and it has a high beta. There are other systematic risk. We're not going to get into those. Beta is not a number you look up on finance. I actually have a t-shirt that says that. Some students got tired of me saying that, so they bought me a t-shirt. It is a forecast. You can look at the historical beta, but the key is what you think going forward. Betas, you can tell that with Walmart. They're terribly unstable. And just look at it. It was high as 1.2, and it's been as low as 0. I somewhat kicked out this period because it was a really different company back here. But if you look just during this period, it's kind of ranged between 0 and 0.6 pretty consistently. But that's a wide range, very, very wide range. Unsystematic risk, firm-specific, industry-specific type of risk. They're easily diversifiable. Make sure in your exam answer you use this word. Unsystematic risks, you don't just reduce them, you can actually completely eliminate them. Once you add about 25, 30 stocks or so, there's comes a point, as long as you have stocks from different industries, once you get to about 20 stocks, completely goes away. And this is also important. It can be easily eliminated. All you got to do is go to Vanguard, buy a Vanguard index fund that has 500 stocks in it, and your unsystematic risk is 0. And that didn't take much work. They hardly charge you anything. All right. Now, you're probably wondering what this has to do with insurance. So this is the key on the exam. So on Monday, think about this while you're writing paper 1. Think about what in the world does this have to do with insurance? And the key is going to be, so here's what you can think about when you get ready for Monday. What type of risk does insurance cover? Does it cover systematic risk or does it cover unsystematic risk generally? And generally things like a fire at a warehouse, a plane crashing, a pollution event, does that sound like a systematic risk that affects all stocks, or is that a company-specific risk? So if insurance covers company-specific risk, what did CAPM just say about that risk to the stockholders? What did they do already? They've already eliminated it. Why in the world would management spend money to handle risks the stockholders have already eliminated? All right, that's where we're gonna go on Monday. All right, so you see where we're going. Any questions on anything?